Hello and welcome to our conversation on financial reporting. In this session, we will examine the financial statements of LG Electronics India Ltd, which was in news because of its IPO. And it is always good to understand the numbers and listen to the numbers before we take any decision about the investments. So LG Electronics is a South Korean company, and we all know that just 1 year back, another South Korean company was also in the news, and because of the IPO. And I call it corporate Korean syndrome. Last year, 27,870 was the size of the IPO, and now the LG is also going to raise 11,607 crores. And both are offer for sale in a sense that in both the cases, this entire money will go to the promoter, who the promoter is selling its stake. So the company will not receive any funds from the Indian investors who will subscribe to these shares. Moreover, just like Hyundai, Korean company LG is also following the suit. Last year, before the IPO of Hyundai Motors, the company has collected or transferred money in the form of royalty, dividend, and of course the offer for sale to the extent of about 45,000 crore. So this much of cash was transferred to the parent company. The same is the case with LG Electronics too. The dividend was paid, the cash dividend, royalty was given to the parent, and now an OFS offer for sale to the extent of 11,000 crore. So around 18,000 crore will be transferred. A big chunk has already been transferred to this. Is it illegal? No, this is a very legal transaction, but you have to understand the spirit behind that transaction. So I call this as a flight of cash from India to the South Korea. From the pockets of the small investor to the large promoting company. So LG Electronics India is a 100% subsidiary of LG Corporation, the South Korean listed company. The total number of shares in LG Electronics India is 678 million shares. And the entire 100% is owned by the parent company. And now the company is going for an OFS, that is offer for sale, whereby the parent company is going to dilute around 15% stake in this company. So let us observe the financial statements of this company to understand the performance, what is visible, and also to understand what is not visible. And the source of this data is from the screener. We can see that the capital has increased from, was more or less stagnant for last 4 years. And in the latest year, it has gone up to 679 crores. And this increase in the capital is not because of infusion of capital or infusion of money by the parent into the company, but it is because of the bonus issue which the company did in November 2024. So in November 2024, November 18, 2024, around 565 million equity shares of face value of 10 were allotted to the parent company by way of bonus shares. So bonus share is also called capitalization of reserves. So the company converted the reserves into capital by issuing bonus shares. So it is also one type of a distribution of dividend. Dividend can be given in the form of cash dividend, or maybe stock dividend. So besides the cash dividend, which we examined few slides back, and the royalty, there is also a non-cash transaction happen in the form of issue of bonus shares. So this increase in the capital from 113 crores to 679 crore is not because of the increase in cash, but because of the capitalization of reserves. Reserves converted to the capital. In the process, the stake of the promoter, the number of shares held by the company's promoters, increases. Then let us observe that on the asset side, the significant portion of the assets are in the form of other assets, and which are receivables and cash equivalents. The composition of assets, if you observe, this being a manufacturing company, is not much on fixed assets. There is a fixed assets we can see is more or less stagnant in the last 5 years. And often we can also observe that CWIP, capital work in progress, which shows the investment in fixed assets which have not put into operation. That is also more or less stagnant or constant this 5 years. That conveys a message that the company is not investing in the creation of property, plant, and equipments. Now let us observe the income statement. Of course, LG Electronics is a profit-making company. We can see that profit consistently positive PBT, positive operating profit, and positive net profit, which is after tax. And continuously, the sales has been rising. So the rise in the sales is accompanied by the increase in the profit. Profit has gone up from 1,500 crore to 2,200 crore. And during this period, revenue has gone up from 15,000 crore to 24,000 crore. So income statement looks quite robust because the rising sales, rising operating profit, increasing EBIT, increasing PBT, and increasing net profit. And we can see that the interest obligations is also very less because their borrowings are non-existent. The company has not been borrowing extensively because the company is earning profit, is a profit-making company. If you see the composition of sales, because it's an electronic goods, we can see that a majority of 34% of the sales are from refrigerators. 24% of the sales are from the air conditioners, okay? So a significant part of the revenue or the sales are from refrigerators and the air conditioners. This also gives us an idea that the LG Electronics is to some extent a market leader. In television, it accounts for 27.5% market share. In refrigerator, 29.9%. And in washing machines is about 33.5% of the market share. So the sales consists of these white products. And expenses, being a manufacturing company, no wonder 65% of the total revenue is the material cost. The material cost accounts for 65%. Interest component is very small. Depreciation is more or less same because no big investment in the property, plant, and equipment. Now let us observe the cash flows. So the balance sheet is strong because the equity is positive. The income statement is strong because the PBT, PAT, as well as the operating profits are rising. Now let us observe the cash flows. What is the status of the cash flows of the company? At a macro level, we can see that the company is having consistent positive CFO, cash from operating activity. That means the business is generating cash from its operations. It's not only making profit, not only earning profit, but is able to convert the profit into cash. Is able to convert the profit into cash. But the worrisome factor is the cash from investment activity. The negative means it's making a very small investment in the creation of assets. And cash from financing is also negative. And we'll pick up and understand some of this with more detail. So observe this. The company is generating CFO consistent positive. But what are they doing with this money? In order to understand that, I just picked up the fixed assets purchase, property, plant and equipment purchase. Very small percentage of CFO is used in the acquisition of property, plant, equipment. This is the purchase of fixed asset. So company is generating cash from operations. So what is the company doing with this cash? And to observe that, we can see that through the cash from financing decision. And this red bar is the dividend paid, dividend distributed. So we can see that a significant part of the cash generated from operation is actually been given as a dividend. No investment in the property, plant, equipment, but for the distribution of dividend. Is distribution of dividend a problem? Of course not. But there is a need for the growth of the company through creation of fixed asset. As per the numbers which are visible in the screeners and the reports, the creation of fixed assets are not visible. And moreover, now the company which is going for this IPO, public issue, the entire 100% is OFS, offer for sale. So this 11,605 crore, the parent company will get by divesting around 15% stake. So the company is already giving dividend, and now there is a big amount of OFS to the divestment of this. In order to understand that, let us observe the explicitly mentioned risks in the prospectus before the IPO. One of them, they mentioned that the dependence on the promoter. Any adverse change in the relationship with the parent and the parent group could have an adverse effect on the business. That's what the company's prospectus says. And there is every possibility the promoter will be able to exercise substantial control on the company and may have interests that are different from those of other shareholders. So it's possible that the company may start another company to compete with LG Electronics. This is only a possibility because there is no contract that the promoter cannot do that. There is no agreement that the promoter will not do that. The second risk, high sales and product concentration. As we have already seen, a significant part of the revenue comes from 2 or 3 products. So a large share of revenue comes from few categories. So if demand in any of these weakens, then the bottom line of the company will be affected. Or if the parent starts another company with producing the similar type of products, then also the demand, the bottom line and the top line will get affected. In the same way, there is a huge dependence of, this is a raw material driven company. So there is a need for risk management on the raw material and inventory management. But however, the company says it sources a significant portion of raw material from a limited number of suppliers. The top 5 to 10 suppliers account for a large percentage of purchase. So there is every possibility that if the supply chain is not properly managed, then the bottom line of the company may get affected because of the cost of the material. We can see that the raw material cost as a in absolute amount, which accounts for around 60 to 70% of the revenue, has been consistently rising. So the concentration of purchase decisions limited to few companies may pose a problem for the company going forward. And the OFS nature of IPO, that means the company is not going to receive this fresh capital. All proceeds will go to the promoter. So the company can't count on the IPO to fund its growth or expansion. Already the cash from operation is used for dividends. Now this OFS is also going to be fully to the promoters. So this limits how much the new investment can be made by the company. And there's a significant amount of contingent liability. Contingent liabilities are the liabilities which are not visible on the annual report directly in the financial statement, but they will be there as a notes to the account. The company is subject to various outstanding tax claims. And interestingly, these tax claims are also for transfer pricing. And transfer pricing is for the related party. And most of the related party transactions are with the parent company. And around 4,700 crore, which is about 73% of the equity of the company, is contingent liability. So if contingent liability becomes actual liability, so there is a possibility that the balance sheet may get weaker. But this is contingent as of now. It's important to note that the company has not made any provisions for this pending proceedings also. Only disclose that as a contingent liability, not made any provisions. So profit has not been reduced to that extent. Provisions have not been created to that extent. Because this is an OFS, because the IPO, the CFO operating cash flows are mostly used for dividend, the company is actually not having cash for investment. The company has paid interim dividends to the extent of 1,800% of the face value, 2,992 million or 2,092 crores and 2,400 crores as a dividend in the last 2 years. And this much cash will not be available. So the company is not using the cash available, cash generated from the operation for the creation of assets. And you may ask, why is it necessary for investment? The company is already running properly. Manufacturing is happening. Productions are happening. But it's possible going forward, the company need to expand, and any failure to raise additional financing could have an adverse effect on the business and financial conditions. The company is having 2 plants as of now, in Noida and Pune. And Noida plant is already operating, 80% capacity. Pune is 72%, more or less. They're reaching to their capacity level. Obviously, going forward, they need to set up new plants. And which they have already announced that in Andhra Pradesh, they're setting up a new plant which may require an investment of 5,000 crore. And OFS, the offer for sale is 11,000 crore. So this 5,000 crore will not come from this IPO. So for this, they have to depend on borrowings maybe, or maybe other sources of money. So there is every possibility that the company may find difficult to raise money or may depend on the markets for raising money, which may affect the margins and the bottom line. To summarize, LG Electronics, as per the red herring prospectus and whatever information available in different sources, we can see that no cash receipt by the company because of the latest public issue. Only two existing plants, both are operating at above 75%. So they need more money for investments. But in the last 5 years, as we have seen, there is the property, plant, equipment, or the fixed assets are more or less stagnant, and the capital work in progress, that means, is also very small amount and is also stagnant. So creation of assets have not been happening, and the dependence on the parent itself will create a problem going forward. So keeping all this in mind, obviously you'll have a question whether to invest or not to invest. So that is a personal decision. But if you listen to the numbers are saying the life is not good, all is not good with them. So the market may be positive for some time, but the fundamentals, as of today, are conveying a different message. So we need to understand the overall spirit of the transactions and then go for the investment decisions. Thank you very much.